How you doing today on this Tuesday, August 9th? You making some money?
I'm good, man. I'm good. I'm excited. I'm excited for what is to come here. It's been a pretty awesome, it's been a pretty awesome last couple of days here, obviously with all the meme stocks coming back into play and having really big runs. But now we got CPI data coming out here tomorrow. I'm excited, man. I think that this CPI number tomorrow is gonna answer a lot of questions that a lot of people have. So I'm pretty amped for it.
Yeah, I agree. So for everyone who's kind of tuning in of like, what's this CPI thing, just to give you a little bit of foundation, CPI, Consumer Price Index, it's basically inflation. You get it every single month for the previous month. It's like a lagging report. So right now in the month of August, we get the inflation for the month of July. As of now, the line in the sand is 8.7%. All those fancy schmancy people with the fancy schmancy pedigrees on their wall, they take a grouping of them, and that's either the median or the average, which for the point of this discussion is essentially the same thing. That is the line in the sand. And a lot of people are paying attention to it because that's the big thing really weighing on the market, also weighing on the economy of, are we in an inflation? Are we in stagflation? What's going on? And to give a little bit more foundation to this particular talk, just on Friday, the first Friday of every month, you get the unemployment report. This one was a special one because they were wildly wrong. They were expecting a new job count just north of 250,000. Instead, there was 528,000, as in unemployment is very low, which is a strong economic sign. We are at a 5-decade low of inflation. And I don't know how you thought about this on Friday, Mike. I thought the market, it dropped so much. And I just didn't, at first, it blew my mind because they were acting already as if the Fed was going to be absurdly hawkish. I was like, you have one of the two pieces. Yeah, it's one thing that unemployment is low, but like, what if inflation's also low? Like, to me, at first, that Friday reaction, and folks, feel free to look at the charts from Friday, it didn't make sense to me because I was like, you only have half the story here. And we're about to get that other half tomorrow and maybe a little bit more on Thursday because we also have the producer price index, which is instead of being a consumer producer, but once again, it's an inflation number. So pay attention to all of that. But right now, line is at 8.7. And I think one of the most obvious questions, and I would love your thoughts, is what happens if we're above 8.7, at 8.7, or below 8.7? What are your three ways to play this?
Yeah. This is something that I think I'm going to go over this also too. I'm going live at 4:00 Eastern today, right at the close,
Okay.
because I'm going to go through like in great detail, the whole game plan with everything, because I think tomorrow is going to be like the markets have just traded sideways for the last week and a half in like a consolidation pattern, which is the exact same setup that we had last time we got CPI data. At the end of May, the beginning of June, we consolidated for 2 weeks, right at 417 on the SPY. You got your CPI number. It was obviously worse than what was expected at 9.1. You had a huge move to the downside. Now, again, another 2-week consolidation at 417. We're about to get another CPI number. I think you're going to get a big directional move here. The opportunity to trade off this number is going to be massive. Going back to what you talked about the jobs number, I wanted to talk about that for a second because you had, and I don't really remember the last time I've seen both sides of the trade, meaning longs and shorts, make a compelling argument that a piece of data works in their favor. Bears took that jobs number where it was double what was expected. And they said, well, that's bad because that's going to keep inflation high. It means the Fed's going to be more hawkish. They've got to keep, it gives them a longer runway to raise rates further, which is a bad thing. Recession. And that both the Bears are like, this works in our favor. The Bulls were like, no, this works in our favor. See, the jobs market is still tight. Unemployment's at 50-year lows. Jerome Powell told you that for the last couple of months that the jobs market and the economy is strong enough to absorb our rate hikes and absorb monetary policy tightening. See, he was right. So Bulls are saying you can't have a bad recession as long as the jobs market is this tight. That's why you got initially the number came out, the markets dropped. Then the markets rallied all the way back up to the high of the day. Then they went all the way back down to the low of the day. Then they went all the way back up to the high of the day. It was a very, very, very choppy day on that Friday. It was up, down, because I really do believe both sides of the trade thought this number helped them.
Okay.
That's now we're going to see, we got this inflation number. We're going to get the answer. And that's why the markets have just basically gone sideways ever since you got that information. And we're going to find out if the number is anywhere near, if you get a 9-handle print forget it.
Yeah.
You're getting 3 days of downside. You're going to be back under 400 before you can blink your eyes if you get a print of a 9 handle. So if this number comes in high, you're going to get similar action to what you saw in June, which is where you got to remember that June crash to the new low. Everybody thought inflation peaked in April.
Yeah.
So when you got the June, that's why the markets rallied at the end of May. It was like, oh, inflation peaked. Wrong. Inflation didn't peak. Everybody thinks inflation peaked again. I also do think inflation peaked. I think 9.1 is the highest CPI we're going to see. But if we're wrong about that, if it's not the peak, you're going to get another move similar to that. Okay. On the flip side, if that number comes in at like, I don't know, 8.3, 8.4, you have more room to the upside here on the SPY to go back and test the 200-day moving average, which is going to sit around 430.
Okay.
But where I'm really interested, where I think the upside is really going to come from is going to be the core CPI number. Because it's interesting, headline CPI is expected to come down from the 9.1, but core is actually expected to move up.
Interesting. So they, for those of you who don't know what core is, that's basically the same inflation, but you take out energy and food. So it's just you're looking at a subset of it, and that's why we get those prints. Is like, okay, and that's a little funky right now just because oil's so high. I think it's currently trading at the low 90s per barrel. So I didn't even know that we were expecting a higher core. I thought they both went down proportionally. That's interesting. So right now, the line in the sand for non-core, just the overall CPI headline is 8.7. And if it's over 9, it's going to be an awful day. Like you said, it's going to quickly drop. But even that range of 8.8, 8.9, I think it'll be red. I think it's a gradient of like, it'll be red, but the higher the number, the worse it'll be. I was of the opinion that if it's 8.6 or 8.7, it's going to be dependent on the other numbers within the report. I'm like, okay, that's close enough. Like, what are going to be some of the important details, the footnotes? And then I was thinking, kind of like the way 8.7, 8.8 and higher, anything 8.5 and lower, the lower it is, the more positive reaction. I mean, if we get your number right there, even potential, I'm not saying you're calling for it, but if it's 8.3, 8.4, I think we go to 420 before we even know it. Like, I think the market will just rip. I think the current shorts who are maybe a little bit more pessimistic are going to be squeezed so fucking hard. And they might be right, they might be wrong. That's the difficulty of a binary event. We're all sitting there at 8:30 just waiting. And right now, as we're talking, the market's coming down a little bit. That could relate to the Biden speech with the semiconductor bill being over. But I love that you brought up the pattern of June. So that mid-June period, there was about 7-8 days of just grinding. And what I thought was so interesting was the day it started to break down was the day before. Our first red day out, and I was like, if that mimics it again today, like we're literally just repeating it of the day before we break out of the consolidation to the bearish side. The next day was a bad number. We gapped, we sold off. Then the day after, we gapped again and sold off again. So if today is a red day, like it doesn't have to repeat. In the world of trading, folks, nothing ever repeats, but there's a saying that it commonly rhymes. And I don't know, like right now we're pushing our intraday lows. If this continues to sell, if we have a drop of 2-3% today, maybe even 1.5 in the overall market, the SPY, the Qs, I'm seeing a lot of similarities to what happened in June, but it could easily pull a U-turn if we come in tomorrow and inflation's a little bit cold or a lot of it cold, and then we could start to rip.
Yeah, man. And this is like that. I think that you're going to get such clarity tomorrow where you got to realize that the market doesn't like unknowns, and that's when the markets really go crazy. It's because the market it's a discount mechanism. It tries to look 6 months, 9 months into the future and then price accordingly. When there's too many clouds in the way and the markets can't figure out what 6 to 9 months look like, the markets go haywire. But you're starting to get a little bit more clarity on a lot of the question marks that the markets had. And this inflation number, I think, is going to give us a lot of trading opportunities. I mean, this has been a crazy year so far, but I think some of the best trading opportunities are actually still ahead of us, because if this core CPI number comes in under the expectation, you are going to get such a rally of cheers from the people that are bullish this market, because they think that the Federal Reserve has pulled it off. It's not stagflation. Inflation is actually coming down. Growth is slowing, but it is still, the jobs market still remains very tight. And listen, you can't have a bad recession as long as everybody in this country's got a job. And when you're talking about unemployment at 3.5%, 50-year lows, I understand the labor market is the last piece to crack, but you've never had a situation in history where you got 2 consecutive quarters of negative GDP growth with record low unemployment.
Yeah. It's
So
funky. And you're almost seeing that craziness in the dollar. Like if you look at the dollar index, like it's just so insane. And that's so representative of how ridiculous this time is. The strongest labor market in 5 decades, but inflation's up, GDP's contracting. And now like maybe it's representative of just like finally getting out of like the situation with the pandemic. Maybe this is like just because those don't happen that often. I mean, geez, it's like a once in a generation thing. So like it could be some weird like whiplash at the end of just like such a strange economic time, and then that's being represented in the markets.
Yeah, the pandemic really changed the way that you look at economics. Honestly, like that's why the negative GDP numbers that we got. It's not because of consumer spending. Consumer spending actually added net positives to GDP over the last couple of quarters. It really has been the inventory builds, the government spending, trade imbalances. These are very weird areas to bring you down to negative GDP, but it's because of the pandemic. It's because of that pull forward of all of that inventory. You look at companies like Target, look at companies like Peloton that literally told you we ordered way too much inventory. Now we're stuck with it. That hurts GDP. It's like those inventory builds, you never had anything like that before because you never had this pandemic where the economy was turned off and then turned back on. So like if inventory wasn't an issue like that, if inventory was normal, you would have had positive GDP numbers, especially in Q1. Q1 was even more, was a much stronger consumer than even Q2. Q1 would have been positive GDP number by far if you didn't have the inventory issues.
Yeah.
So that's why it's a very straight, and that's why you have this debate. Like everyone's talking about like, oh, well, maybe we need to change the definition of a recession. People are like, no, you don't need to change the definition of a recession. You just need to realize that every recession is not 2008. Yeah. And that's what I've been trying to tell all TeachD members. It's like, everybody hears the word recession, they panic. Recessions are not something to be scared of. Every recession is not 2008. 2008 is a worst case scenario. This is not a worst case scenario. And it's an opportunity to grab asset classes and different assets and prices that are significantly discounted.
Yeah, no, I definitely am in agreement with you there. So I appreciate you like laying out your scenarios and how you're going to react or your prediction for the three. But if you had to throw out just a guess right now, I mean, for example, I think we're actually going to come in hot, and it has nothing to do with inflation really, because I see things are calming down in the world of real estate. I see commodities are coming down. My thesis is the fact that I'm now seeing way too many articles telling everyone that the bottom's in, like just too many articles. And I'm like, and I know that's kind of messed up, but like it is, as soon as I see that, because like recently I think people got too bearish. I think they got in front of themselves. They're like, we're going down, down, down. And then a couple buyers came in and the weak shorts in terms of the overall market, like, and that's why we saw this bear market rally. So I was waiting for that to inverse a little bit. And over the past week, I'm seeing too many articles of people like really flaunting that they're right. They're like, see, I told you, bottom's in, we're ripping. And I'm like, I think the market is about to humble them. So maybe it's a little pessimistic, not really based on any other metrics besides like, I guess, fading the public financial media sentiment. But I'm curious what your thoughts would be if you just had to throw out a guess of where you put that number.
I don't think that we're out of the woods yet. Okay. I'm not in the camp that we just go right back to all-time highs. I know you have a couple of people like Bill Belsky from BMO Capital. He's a ultra bull. He thinks we're going over 5,000. Tom Lee from Fundstrat, who I respect the hell out of. Tom Lee's actually been dead right about everything starting from the COVID crash. Every call he's made in the market since the COVID crash, he's been dead right on as far as more lows, new highs, holding things. He's been dead right throughout the whole process. He thinks we're going back to 4,800 at the end of this year. I'm not necessarily in that camp because at the end of the day, the Fed is still going to continue to raise rates. And I really do think and you and I even talked about this, going back a month or so. I've been telling people like I added in my long-term portfolio, in the summer. And I was telling people that I was adding my long-term portfolio in the summer, but I still have some cash on the sidelines that I did not get into the market yet. And people that are like, oh, damn, I wish I listened. Because I didn't know this at the time, but I added a big chunk on June 17th, which is the low of the year. Now, full disclosure, I did not say on June 17th, this is the low, I'm going in. No, but it was a level that I was looking at. The markets were down 23%. The SPY, the S&P was anytime the S&P goes down more than 20%, I add. I don't care what the reason is. You go back over the last 100 years, whenever the market's down 20% a single year, if you buy, you're up 1 or 2 years later. So that's what I did. And now a lot of people were too scared at that moment to actually step in and buy because they thought the world was ending. Now they're like, oh man, I missed it. And like people are getting very anxious to like chase this market higher. And I'm just telling you guys, I still have cash on the sidelines. I don't feel the need to chase these markets higher. I don't think we're out of the woods yet. Are the lows in? The only way I think we break that June low is if this inflation number is hot. Yeah. You know, if it looks like inflation has not peaked, that's going to be a real serious problem, because then that you're really going to start talking about stagflation. You know, you're talking about the Fed having to be a lot more aggressive, and then you possibly would break the June low. If you don't get that, I think you could probably go back down and test those lows as you go towards the end of the year and you see the effects of the Fed's tightening. But I don't think we break them. And then it just becomes a matter of, do we actually avoid the recession? Or we're in a technical definition, but when I'm talking about do we avoid a recession now, I'm talking about, do you avoid a big spike in unemployment? That is what the real recession is going to feel like, because as long as everybody has a job, you don't necessarily feel like you're in a recession. So I just think that people just need to be patient. There's so much opportunity in this market from an active trading standpoint, but it is also from a long-term investing standpoint. You had phenomenal opportunities in the summer, but I think you're going to get more.
Yeah, no, I think that's definitely some great insights. But for everyone watching this, well, I hope you're watching this before, I guess, 8:30 on Wednesday, the 10th of August. I think that's when the report's coming out. It's an hour before the market opens on Wednesday. So hopefully this has given you a little bit of foundation. But as always, Mike, I appreciate your insights. It sounds like you're going to be doing an additional breakdown at 4 p.m. today. So folks, feel free. That's just free over on their YouTube channel. So feel free to check that out, and we'll find out soon enough, Mike. I'm excited to see how this plays.
And hold on. I gotta address a comment here, Mr. If you don't mind, Matt.
Yeah, go for it. I
gotta address a comment here, man. Mr. Mitch Holmes says, "Look, it's the AO guy. Why in the world should we care what you have to say? Sell me a course, bro." So yeah, guys, listen. I'm going live at 4:00. Yes, I sell memberships on my live streams, but why should you care about anything that I have to say, brother? I didn't figure this stuff out on my own. Okay. I began my career working at a hedge fund in New York City. I was trained professionally by professionals on Wall Street. I received the Trader of the Year award. This isn't something I figured out in my mother's basement. I've been doing this for over 15 years. If Matt didn't think that I had educational value, that I can help his viewers, go through certain topics, understand certain things, he certainly would not have me on the live stream. So Matt, I appreciate you always, bro, having me on. It's always fun to kind of mix TGD fan with the Moon Gang. It's always a pleasure. But yeah, I sell memberships on live streams, but that doesn't take away from the educational value of the information and the analysis that I provide on those streams. So I'm going live at 4:00 Eastern, right at the close. We'll talk about the CPI a little bit further. Matt, I'm sure you and I will have another conversation after this number comes out tomorrow. It's going to be a crazy day. I'm looking forward to it. I can't wait. I think there's going to be so much trading opportunity for us going forward from here. So thanks for having me on, man. Good luck the rest of the way to you and the Moon Gang.
All right. Thank you so much. Catch you soon. Have a good one.
Take care, bro.
Bye.